This is the hard numbers audit. We are the owners of Stone and Browning Property Management. We just wanted to bring everybody here. We've been trying to ramp up these educational webinars on a monthly basis just to provide more value to our clients and potential clients, as well as the rental property owner community in general. So really appreciate everybody taking time out of their day to be here. What are our credentials to be talking about how to underwrite real estate projects? Again, we've been in the property management industry through Stone and Browning Property Management for 12 years now. We manage approximately 1,000 units throughout Vermont. We have won the Vermont Business Magazine Best of the Best Property Management Companies in Vermont for 5 years in a row. We won't talk about 2023. That's irrelevant, but we've won 5 years in a row. In addition, we are the owners together of another entity called Granite City Investors. That business has been around for about 10 years now. We own, through the two of us and other various partnerships as well, approximately 200 units in that entity, and we're constantly growing that. So this is really going to be a look behind the curtains on how we approach underwriting properties, making sure we can preserve cash flow, and that we're getting a good value from day one. That's a picture of our property management team. These are the individuals that do the real work on a day-to-day basis. They're the reason that we won the Best of the Best Vermont Business Magazine Award 5 years. For them, we're extremely appreciative. We would not be here without them. So thank you very much, guys. Warren Buffett, not even a real estate guy, hit the nail on the head here. Your cash flow and profit are locked in the day you buy based entirely on the price that you pay. He's 100% right. The hardest asset to own and the hardest asset to manage is one that doesn't cash flow. Economics happen, interest rate environment's changing, costs are increasing. If you're purchasing a building from day one with no cash flow, you're going to be in trouble once you fast forward 5 years or so. Buildings need the cash flow from the day one that you purchase it. And one of the biggest levers that you can pull, you'll hear me kind of talk about that throughout the webinar, the different levers you can pull to influence certain parts of the analysis. But one for cash flow is how you purchase the property. Are you buying it at the right price, a competitive price based on the actual financial data that you're looking at for the property, not realtor performance? Want to just kind of lay the foundation here. This is where we were when I got the word that we weren't in the webinar, so apologize, but want to lay the framework quickly for some basic terminology. Some things are interchangeable throughout the industry, whether you're working with realtors, other property owners, other investors, other colleagues. But from how we interpret things, how we look at everything, I just wanted to run through some of the terminology that we use over here at Stone and Browning Property Management and when we're buying and acquiring entities through our other partnership as well. As I'm working through these and kind of try to picture a profit and loss, I'm going to work my way from the top down. From a profit and loss, we're going to begin on income, go to operating costs, and then go down to like the net profits and how to analyze and interpret those. So every piece of real estate has the ability to earn income. That's what we refer to as potential income. And potential income is if all of your revenue streams, your rents, your laundry, your parking, your storage, if all of those are 100% maximized and everybody's paying on time. We know in the real world that does not happen very often. That's always something we're all striving towards as real estate investors and owners. So just know that the potential income is the ultimate goal. That's where you're trying to get to, but that's not what's happening in practice. The vacancy rate, there's two different types of vacancy rates when you're thinking about buying and acquiring properties. One is the market, which is really recognized after you've taken your property through the stabilization period. What's a stabilization period? When you purchase a building, it's going to be kind of the changing of the guards a little bit. There's going to be new management style in place, new ownership structures in place, new expectations, new goals, new debt. Lots of things come into the picture that are brand new that are going to influence how that property performs. It's also going to influence how the residents react within the property. It could increase your vacancy rate over time. It could increase your operating costs, all kinds of things. But the market vacancy rates really recognized once you've gone through that once you've gone through that stabilization period, and things are kind of regulated and balanced out now. There's not so much volatility with the project. Economic vacancy is just the opposite. It's the vacancy that is happening throughout that stabilization process. So if your plan is to go in and, renovate 80% of the units and try to increase rents, well, you can't underwrite with a market with any kind of market vacancy rate at that point in time, because if the market's 5 and you're overhauling 80%, you got to know for the first couple of years your economic vacancy rate is going to be much higher than the market vacancy rate. So just have that in the back of your head. Both account for lost revenue from empty units. Both account for non-performing tenants, and it's just something that gets the economic vacancy rate gets really forgotten about in our industry, especially as it translates to the smaller multifamily properties. But it's a very real piece of the equation that comes into the picture. And it comes into the picture for us as a management company as well, right? Because we're the ones that are trying to control that and keep that under wraps as much as we can. Next factor is loss to lease. This is one that does not get talked about a lot. If I go back to the other slide here for potential income, I kind of had an example of if you had 10 units renting at $1,600 a month, that equates to $16,000 a month in potential rents. Loss to lease factor is the delta between your potential rents and actual rents. So if you purchase a building that has the potential to generate $16,000 a month in rental income, but it's actually only generating $14,000 a month, in income, there's a 12.5% loss to lease factor there, right? So you need to be underwriting your project at the actual rents being collected, not the potential rents being collected. A couple nuances in there that we're not going to get into the call, not going to get into today on the call. But if you knew that you could get rents to that market level quicker, you could be a little bit more aggressive, and that isn't as much of a factor. But for the most part, you want to be relying on actual rents collected with your purchasing. The next piece of the equation is going to be rental concessions, the perks, especially in Chittenden County right now, where there's a lot of new supply coming online. You see a lot of these rental concessions kind of popping up. 3 months rent, no deposit, flat screen TV when you move in, whatever it might be, free storage unit, things that were once revenue are now being given away. And that is all going to trickle down to the bottom line at one point or another. Use a deposit as an example. If there's a company that's charging no deposit at the move-in and they never collect a deposit, or they're going to collect a diminished deposit, when that move out occurs and there are damages to withhold from, you might not have a deposit to pull from to be able to pay for the damages. So that's going to mean your operating costs are going to elevate. Your net operating income is going to go down. So we're going to have a conversation about that in a little bit as well. Your other income. Vermont's not like the rest of the country. We have kind of limited other incomes unless you're working with the larger assets. But for the most part, there's some laundry, there's storage, there's parking. There might be a couple other things that work their way in, but those are extra revenue points that all trickle down to the bottom line as well. And there might be some value to create there as well. All of that, your potential rents, less your loss to lease, less the concessions, less the vacancy rate, either economic or market, plus all these other income items equal your gross income. So your gross income is what you're actually collecting on a monthly or annual basis once you've factored in all those other items that we just went down. All right. Operational expenses. Rule of thumb that we find, Vermont assets are old. All of them are 100 plus years old. Well, not all of them, but a good chunk of them are. So for the most part, we're dealing with assets that have old plumbing, old electrical, old heating, old mechanicals. They just need some love, right? So operating costs as a percentage of your gross income usually falls somewhere between the 40 and 55%. 55% are those lower unit count projects, the 1 to 2 to 3 unit buildings, and it kind of reduces down the more units you have under one roof there. And there's a lot of things that influence that as well. There's, how much rent are they collecting? What is the vacancy rate? Are you able to expedite that value add process to get income up a little bit quicker, a little bit faster? So there's ways to kind of pull the lever to influence this amount, as well. Operating costs for buildings include your property management fees, taxes, insurance, utilities, repairs and maintenance, anything that goes into running the day-to-day of a property but it doesn't include the mortgage payment or other depreciable items. But what I mean by depreciable items, if you look back at previous webinars we did one with our accountant Rita in January. We talked about if you do a major overhaul of an apartment and you're putting a significant amount of capital into that to bring it to, where you want it to be, where it needs to be at that point in time, you can't always expense the cost of rehabbing and renovating that one unit within the building. A lot of those items have to be depreciated over time. It's also viewed as a one-time expense for the most part. It's not going to be recurring on a daily, weekly, monthly, annual basis for that unit in particular. So those items usually don't fall under a traditional operating expense factor there. Then you trickle down to the net operating income, which is really the number that we all want, we all try to change, we all try to influence, and it's your gross income less your operating costs equals your net operating income. So rule of thumb, the higher the NOI, the higher the value of the property. The lower the NOI, the lower the value of the property. I should have prefaced at the beginning, I apologize I didn't. This presentation is going to pertain mainly to commercial valuation, commercial financing, so 5 units and more. That's typically what we manage for the most part. Single family, 4 unit and less properties, they are valued often an income approach where they really take a hard look at the NOI, but they also blend it with comparable sales approach, and they tend to give a little bit more weight to that than they do the income end of things. So when we're talking valuation from an NOI point of view, it's really pertaining more to the commercial assets, which are 5 units and more. But again, to recap that, the higher the NOI, higher value, lower the NOI, lower the value. Kind of a easy way to wrap your head around it there. NOI is going to be determined by a lot of things too. It's how much rent you're charging, what are your operating costs? Are you controlling this amount over here? Are you purchasing at a 50% expense ratio, and are you reducing it down to a 40 or 45%? All that's going to translate to higher NOI, higher value. So really got to know the plan for your building, what you're trying to accomplish, what's happening in practice now, what's actually happening, and how you plan to influence it and if it's realistic or not. After you get down to NOI, you have to factor in your debt service, which is your bank mortgages, your owner mortgages, if there's owner financing in the picture, other municipal loan programs or state funded loan programs, line of credit, anything that you have to pay off over time is going to fall into that debt service end of things. Next piece to know is what a capitalization rate is, or a cap rate. A cap rate is basically just a market-driven multiplier that we, for the most part, don't have a whole lot of influence over. It's really based on investors' willingness to pay based on the NOI of a property. So I just kind of threw 3 examples down here. If the NOI of property 1, 2, and 3 identical properties, 3 different buyers, but the NOI of all 3 of them was $100,000, and one buyer was willing to pay $1 million, and then buyer number 2 is willing to pay $1.2 million, buyer number 3 is willing to pay $1.5 million. That would translate to the different cap rates over here on the right: a 10%, an 8.3, and a 6.5 or so. To get a quick gauge on what market cap rates are, just call your lender up, ask your lender where things are trading. They're looking at appraisal reports regularly, so they'll have an indication on kind of where market cap rates are landing and what properties are trading at. There's also some local publications, the Brooks and Minor report for the Chittenden County market that comes out once or twice a year. They usually have some information around, what the Chittenden County property cap rates are trending at and where things are trading. So easy math on that one. Again, NOI divided by the purchase price, multiplied by 100, that's your cap rate percentage. Your cash flow is the gross income less operating expenditures less your debt payments equals your cash flow. That's the take-home profit remaining at the end. And banks like to see things at cash flow, especially if there is a large value add play there. There's a lot of deferred maintenance. You need some cash to do things and make repairs and do renovations and plan for future capital improvement items as well. Banks also like to look at, and if you look back at our previous webinar we did with Dave Rubel from Community National Bank, we had a long conversation around debt service coverage ratio, or DSCR. Basic math on that one is your annualized net operating income divided by your annual debt service. So for an example, if our net operating income is 100,000, our annual debt is 80,000, that's going to equal a DSCR of 1.25. Lenders typically like to see a minimum of 1.2, and this is how it's like a miniature stress test for the lenders. They want to make sure it's a way for them to indicate that the property produces enough net income to meet the debt payments and then have a little bit left over for things that kind of pop up out of the blue that, so you're not having to pull out of your pocket. If that dips below 1.2, lenders look at it as a way of, okay, if something changes, the building's not producing as much income, you hit a higher vacancy rate period, operating costs go up, it's a risk that you're not going to be able to meet the debt obligations strictly from the income of the property. So it's a pretty important item that they have a peek at. When you're purchasing a building, it's important to know how that translates. The biggest mistake we see as property managers, and we've done as owners as well, when we've bought, early parts in our career, we bought things not correctly, and we've had to kind of navigate and pivot over the years. So these are a couple of errors that we made along the way as well. But these are definitely regular things that we run into as we get new property management accounts and new property management clients. One is not understanding the difference between real pro forma and actual financial data. Realtors love them. There's great ones out there, but they're not investors. Their job begins, ends when you buy the building, right? They usually don't have an interest in how you do after the fact. They just want you to buy the building. Again, there's some great ones out there that know how to kind of interpret it, but they usually produce what they call realtor performas, which is their interpretation of what the market rent could be, what stabilized operating costs could be, and that's how they value the property. It's a good place to begin a conversation, do some back of the napkin math, but then you really need to check and verify what is happening from an actual financial point of view. So it usually paints two very different pictures usually. Purchasing should be happening on actual financial data, usually a trailing 12-month profit and loss, tax returns, a couple years worth of profit and loss, so you can find some trends. It's a good way to really just make sure you're looking at actual financial information to determine a good purchase price. The next one is not understanding the difference between the market vacancy rate and economic vacancy. Happens to us all the time. Owners buy a building, their plan is to go through, renovate half the units, and we're having a conversation halfway through the year about why we're not running at a 3% vacancy rate when we're turning over half the units throughout the year. Like there's a correlation between the two, and understanding the difference is really, really important. So it's good as you're doing your underwriting to project out a couple years, project out through your stabilization period. Know you're going to have an elevated, economic vacancy rate in years 1, 2, 3, or however far out you're going to be going, and things are going to kind of taper off after that stabilization period. It's important to know. Unrealistic revenue growth projections combined with unrealistic operational costs during stabilization period. So two different levers here. Owners frequently come in and say, I want to ramp rents up, not understanding the trickle-down effects that have. Ramping rents up creates higher vacancy, creates more vacancy, creates turnover costs, creates holding periods, all kinds of things. So yes, you can do it, but it creates a trickle-down effect on the operating cost end of things. And if they say, I want to ramp rents up and I want to keep operating costs at 40%, we're already behind the 8 ball a bit, because operating costs need to increase because you're going to deal with all the turnover. So just having that in mind as well. Kind of translates into unrealistic expense ratios. We have owners come in regularly where they say, I want to rent this building out. Here's the rents I want. And then I want to run at a 25% expense ratio. Just unrealistic in practice with the amount of property tax increases that are happening across the board now, utility costs, labor costs, material costs, all the things there. Like being realistic with how much of your income is going to operational costs is extremely important. Again, minimum rule of thumb for traditional assets in Vermont, even in the Northeast, 40% is a good rule to use. 40% of your 40% of your gross income is going to operational costs. It can go lower if it's a newer asset that has less maintenance, but for the most part, that's a good rule of thumb. The big one that we run into is no stress testing when underwriting. And what I mean by that is, and we'll get into it in the next slide here, I believe, or the one after, You got to plan for the worst when you buy a property. Things very rarely go according to plan. They might go close to plan, but things come up. Interest rate environment changes. I ran through all of them earlier. Interest rate environments change. Operating costs go up. Turnovers happen. One thing we're watching really, really closely right now as a management company is just people's ability to pay right now, right? Everything around them is going up. And when something needs to give, it's going to be rent payments. We don't see that happening quite yet, but we're just watching it just with what's happening in the world right now. So you need to stress test your underwriting. What happens if I run at a 5% vacancy rate as opposed to a 3%? What happens if in 5 years after my fixed rate period expires, my interest rate goes from 3% to 8%? What happens if my plan was to exit out of this building in 5 years and it's not trading at as low of a cap rate and my price that I can achieve is less than what I thought? Like, how does that translate into the bigger picture, the long-term picture for you as an owner? Gotta stress test your underwriting a bit, and I'll kind of run through that in future slides here. Just to recap, this is my least favorite slide I did. I was doing such a beautiful job, but my formatting here looks like a child wrote it, so I apologize. But just recapping what we went over, kind of tried to lay it out like a profit and loss a bit. But you have your potential rents at the top, max rents, everyone's paying, everyone's on time, no amount of vacancy. Loss to lease, the actual versus what the market rents are, kind of what the delta between the two is there. Vacancy factor, economic versus the market, other income streams there, parking, laundry, and whatever else might be in the picture. All that translates into the gross income, which then you then have to evaluate operating costs from there. And your gross income less your operating costs results in what your net operating income is for the property. Back out your debt service at that point in time. You can calculate your cash flow, and then your debt service and your net income. You can calculate your DSCR to make sure you're hitting the benchmarks for your lender and for you as an investor. Hopefully you can achieve the goals you're trying to achieve. If anything's off there, you'll kind of know the different levers you can pull to influence it, and your lender will be happy that you're coming to them with this level of insight and this level of information. Backing into like a baseline valuation, this is where we begin like every conversation when we're looking to purchase a property. We know what the NOI is. We've kind of stress tests some things along the way. On the income, we're looking at actual income. We're looking at actual operating costs. So we feel comfortable with the NOI that we're producing. And then we divide it by the market cap rate, and it equals a rough valuation at that time. So if our calculated NOI, these are completely just made up arbitrary numbers, not relevant to anything. But if our calculated NOI is 100,000 and we know the market cap rate's about an 8%, meaning property owners are willing to purchase buildings based on their NOI at roughly 8%. We know a valuation to begin having a conversation around is roughly $1.25 million. That would adjust up or down depending on age of asset, stability of tenants, type of demographic, deferred maintenance, age of mechanicals, age of infrastructure, all kinds of things. But that's just a good beginning point for us to start, tweaking up or down based on what's happening in the real world. I talked a little bit about the levers you can pull, but there's really three main ones that we have direct influence over as a property management company and property investors. One's the income end of things. If we can increase rents in a controlled way, in a fair and equitable way, that's going to result in a higher NOI over time. If we can maximize additional revenue streams such as storage and parking and laundry, that's going to result in a higher NOI over time. If we can reduce the vacancy rate and really make sure we're renewing all the leases over time and we are really concentrating on retention, that's going to trickle down to a larger NOI over time. And inversely, if we can fine tune our operating costs, if we can reevaluate property insurance, negotiate better utility contracts or better service and supply contracts, that's going to equate to a larger NOI over time. And then the best thing for cash flow is if we can package our debt better. If we can make sure we're negotiating the best interest rates that we can, we're looking at amortization periods that fit within the models that we're trying to achieve, and we can purchase the property correctly. So the biggest factor in there is what the purchase price is. that's going to help influence cash flow and really make sure things are churning and you're teed up for a very good project from day one. So put together just a quick little spreadsheet. Again, not an artist, so I apologize if it's a little childish, but just tried to recap that whole presentation, whole conversation there, and really talk about, again, where the different levers that you pull. Lever one is on income, lever two on expenses, lever three on the debt. That debt kind of translates over here to the right. So we'll just run down this top to bottom. Hypothetically, irregardless of the unit count, if I have a building that has the potential, based on what the market rents could achieve, to achieve $150,000, and my loss to lease factor, so here for actual rents, I'm going to look at an actual rent roll report from the owner and say, I know my realtor performer told me I could get $1,500 a month, but what are you actually getting on your rent rolls right now? And you find out, oh, it's $1,200 a month, right? That annualized rental revenue is going to be an actual amount, and that's going to be your loss to lease factor there. So looking at those actual rents is important, but I know there's a loss to lease factor in there. So this gives you something to strive towards. Now it's up to you through homework, research, questions, asking us as a management company could be an equation, to determine if the market rents are a realistic target or not. But that's going to give you a target to strive towards. But right now you're actually collecting $139,000 a year. Another error I forgot to bring up in the back is I see property owners calculate the market vacancy rate based on the market rents. That's going to arbitrarily, wrong word. That's going to artificially inflate your net operating income because you haven't achieved these rents yet, right? You need to make sure you calculate the vacancy rate off actual rents that are coming in. So the 7% vacancy factor was happening. And again, you can calculate that by, the rental, the rent roll, annualized total for the property owner, because you're going to ask that as part of your underwriting. And you're going to say, what's your rent roll right now? And then you're going to get a tax return or a trailing 12-month profit and loss. And you're going to look at what they actually collected from a rent roll point of view for the last 12 months. Work out the math, and you can find out roughly what the vacancy rate is for the time that they've owned it. So you're going to plug in a vacancy rate there. And again, all this is completely made up. So it's not relevant to a real project at all. Maybe one day we can do underwriting of an actual project, but and then you factor in your other income items. This could be laundry or parking, again, whatever it might be. And that's going to get you down to your gross income. So again, your gross income is the market rents, less your loss to lease factor, less your vacancy, plus your other income. Boom, there's your gross income. You then want to make sure your expenditures are in line with what you're producing for a gross income. So this one is working out to just under 48%. So that's pretty comfy right now. I feel good about that. But again, you can look in here, pull this right off a trailing 12-month financial report, find out what's happening. But then you got to ask yourself, are these numbers realistic? Another thing that happens a lot, and here's an example. I thought I wrote 10,000 there. I wrote 1,000 there. Sometimes accounting errors happen, bookkeeping errors happen, and owners will give you profit and loss information that isn't 100% accurate. So you got to check and verify everything. If you see, just use this one as an example, if you see a building that looks like this and they're only paying $1,000 a year general maintenance and repair, big red flag right from day one. Like, that's wrong. You gotta kind of back into it and find out what a realistic amount is. From a general maintenance and repair item, rule of thumb we use is between $750 to $1,200 per unit per year. And that's influenced on, again, how much deferred maintenance is there, what's the renter demographic, what's been the amount of retention over the last 12 months. Have they had a lot of turnover? There's a lot of things that go into that. So let's just pretend this is a stabilized asset or so, $750 a month. Let's just enter what I was going to do, $10,000 a year. Okay, that's going to change your operational costs from there. So now you know your gross income, you know your total operating expenditures. That translates to a net operating income of $61,000 and change. And my debt is coming from over here on the right. Again, basic calculator. I apologize if it's a little hard to follow. If I'm going quick, I apologize as well. But your debt's going to come from over here on the right. So what I have in the top is, based on this net operating income of $61,000 at an 8.5% cap rate, that would translate to $720,000 worth of value, which would be a potential purchase price. If you put debt on $720,000 worth of property value for 20% down at 25% amortization period, 7.5% interest rate, your debt service is going to be $51,000 a year, which means you're going to cash flow net operating income less your annual debt. You're going to cash flow a little over $10,000 a year, and your debt service coverage ratio hits 1.2. So the bank's happy, you're cash flowing. How that cash flow translates into what you're trying to achieve from a return point of view, that's up to you as an owner. But it's just a good way to work your way down the income and the financials and make sure you are in line with what industry benchmarks are and what real multipliers are. So you're actually looking at real information. And again, levers you can pull. You can say, okay, I feel confident within the first 12 months, I can tighten this loss to lease factor up at 3%, and I can get vacancy to 5%. Again, work with a management company to make sure it's real. You can actually achieve those. And I know for the most part, my general maintenance and repair might bump up a little bit throughout that period. You get a little bit, you can make sure, okay, I'm still cash flowing. Debt service coverage ratio didn't change a whole lot. And the valuation changed a little bit. You can play with other things and stress test it and say, okay, what if my lender doesn't let me do a 25-year amortization? What if I'm working with a bank that's only going to let me do 20? Well, that no longer hits the debt service coverage ratio. You still cash flow a little bit, but is it enough to weather something major that might come down the line? What if I bring some investors in and I can bring 30% to the table? Okay, now I have a more favorable debt service coverage ratio. I have a little bit higher cash flow. My bank's happy. I'm happy. Maybe it's hitting, the investment objectives that you have. We're not going to get into that on the call today, but maybe on a later date, we can do some more like investment level return objectives if there's investors in the picture versus not, or other partners in the picture or not. But just know how all this information is interpreted, how it's translated, how it's influenced, more importantly, and what's realistic and what's not. And make sure, again, the hardest asset to own is one that doesn't cash flow. Hardest asset to manage is one that doesn't cash flow. And a lot of that comes down to the purchase price that you're willing to pay for the asset from the very, very beginning. So being realistic with your purchase prices, being realistic with your income projections, realistic with your expense end of things is really, really, really important. Work with a property management company like us. We'll be able to kind of tell you what's happening in the marketplace, talk to others that are in the business as well, find out what they're running buildings at. But just know how you can pull the different levers to influence the bottom line. Okay. I'm going to open it up to some Q&A. I know there's some folks on the call that might have some questions. That was very high level, very quick. It's about 40 minutes, so move through that pretty fast. Apologize if it was a little quick, but want to answer your questions. And this is meant to kind of spark and fuel more conversations. So feel free to reach out to us at any point in time, and we're happy to have more of a conversation about this as well. So Mark, are you able to view the Q&As on your side?
I am. Yep. I just sent a chat out to everyone just saying, if you have questions, feel free to drop them into the chat box and we'll get to them. Also too, this recording will be kicked around after too. So if you need to slow it down a little bit or want to revisit something, you'll have the opportunity to do that. But Rube, one comment, not really a question, but another challenge that we see a lot as property managers is, and specifically up in the Chittenden County area, but is a lot of people throughout the past 5 years or so were buying and banking on appreciation, right? Like they're buying to hope that the value of their building is going to increase over time. And that's really how they're analyzing and purchasing things. And that makes it really challenging as a management company as well. For us to execute and hit, objectives that these guys have in place with them, and with their only goal really as just banking on the building appreciating. And we've been seeing some, I don't want to say downturns, but we've been seeing some changes in the market that are interesting to pay attention to.
Yeah, I mean, it's very, very real. We had two larger assets that we purchased 5-6 years ago now. Our fixed rate periods on the building expired. We had to refinance, and interest rates more than doubled. So we were at 3.5, something like that. and where you're having to refinance a little over like 6.5, 6.75 in that ballpark. That really changes the picture of a cash flow of a building. It doesn't impact the net income, right? Because that's that debt piece is below the net income is factored in after, more from a cash flow point of view. So it hurts cash flow, didn't hurt net operating income, but because cash flow is diminished, people's willingness to pay that higher dollar amount is going to be diminished as well, which means even though the net income is not changing, the appetite for purchasing at those elevated purchase prices is less. So owners are going to reduce their purchase price. And after enough trades like that happen, those cap rates are going to go up, right? So the market multiplier, when it comes to exit or refinance, your valuations might not come in as high as you originally projected 3, 4, 5 years down the road, especially after coming out of an environment like we did the last 4 or 5 years here. Yeah, it's very real things out there. And if you're not, again, stress testing, you're underwriting to say, what happens if 5 years down the road, I don't get to refinance at the level that I thought I was once going to? What if the cap rates do go up a whole percent or 1.5%? What does that do to my valuation? What does that do to my ability to refinance out of a project? Again, we did a really good webinar with Dave Rubel in March that we talked a lot about those items and kind of what that process looks like. He'd be a good one to reach out to. Yeah, there's a lot of that happening right now, for sure.
Yep. Yeah. So no questions on this side, Rube. So I think we're good. I don't know if you want to touch on next webinar coming up.
Yeah. And again, you have our emails at the beginning of the presentation. You're going to get the follow-up emails. Feel free to email us any questions. We'll try to get back to you in a timely fashion, and reach out to us if you want to have more of a conversation. Next webinar that's coming up is going to be Thursday, June 25th at noon. Tentatively right now, you'll get an email, but that's pretty much locked in. But it's going to be a legislative overview, a deep dive into H772, which was the big housing related bill that just failed passing. So we did this intentionally with Angela in July, or at the end of June, because we wanted to have a conversation around, one, if the bill passed, what it meant for property owners. But if it didn't pass, we wanted to have a conversation around what was being proposed, why it failed to pass, what to expect next legislative round, and then educate our owners and like-minded investors on how they can get involved to help influence the next housing bill. This bill that was proposed, we kind of kept our hand on the pulse of it pretty close. I did a little testimony down at the State House. I've done it the last couple of years. There were some good things that came out of this bill. There were some not so good things that were coming out of this bill. So I'm part of me is bummed it didn't pass. Part of me is a little happy it did, because we would have had to pivot and change a little bit. So for now, it seems like things are status quo, operate as you have been operating. No big major changes right now, but it's beginning to gain more and more traction each year that we go through this process. And this was the closest big housing reform bill that was introduced, and it didn't pass, but there was a lot that was being proposed and a lot of big changes. So that's what's coming up next. Mark your calendars. You'll get some follow-up emails from us on that.